generation sources and how they fit in, what are ultimately the flexibility needs, and where curtailment might happen. This is not a copper plate variable, so marginal cost model. Rather, we're looking at networks and provincial boundaries, country boundaries, and local profiles as much as possible. That's a real challenge in the China context because there wasn't a lot of data. There were ways to create data sets, but while the power system information was typically coming from statistics bureaus and things, actually all of the renewables was in the public domain because we knew where the projects were happening. There was tendering, people were building roads, there's wind measurements going on. So this was a kind of interesting perspective of we could actually see how development is going to go in the next 3 or 5 years because we know where investment, where development efforts are going. Also, the capital market was different in that these were state-owned enterprises funded by the state-owned banks, and there wasn't a project attrition, as you would typically see here in Europe, where only the best projects ultimately get financing at the right time by addressing risks. So, yeah, here is just looking at, the fact, and I think we have to remember that basically half of the wind and solar and batteries installed in the world today are in China in this highly regulated market. And there are big changes there that maybe are kind of relevant to the experience I'm going to talk about later here in Europe, where we have something that China actually doesn't, and that is a liberal power market, a liberal banking sector, and an ecosystem of trading and other things that actually doesn't exist yet in Asian markets. This is an example of looking at what are those security-constrained economic dispatch type models. This was some work I did around 2020 looking at Taiwan. Interestingly, that it's an island. The largest source of flexibility that we have here in Europe is imports and exports. So Taiwan, being an island, doesn't have that, and so it becomes an academic example of how much wind and solar and batteries can you add to have a system that has adequacy in terms of resource to match in the worst conditions of load and production, so seasonal production. And I'm not showing here the seasonal profiles, just picking one particular week in the winter, and then looking at future expectations of capacity additions, how the transition is supposed to happen, and in terms of the flexibility that could be afforded by this kind of gray area net load, which is typically accounted for by gas or in the future hydrogen. We still have imbalances, and we would still have curtailment. Here it's shown as looking like the solar is being curtailed, but the whole green area below is offshore wind. And the regulator would have to decide who to curtail and when, so it wouldn't be just applied on the solar, but the solar is the peaky one. But in this context, of course, the government is saying, well, if you're going to do 100 megawatts of wind or 100 megawatts of solar, you should do 10 megawatts of BESS on site. And we can look on a dispatch basis, what kind of an influence that would have. And yeah, it would reduce some curtailment, but actually this BESS is not particularly utilized because without a market price signal, you're only going to dispatch at certain predictable times that lead to the BESS being used only in those seasons where there is some curtailment. Probably for half of the year, there's no curtailment in this model. So the BESS, the batteries are just sitting there unutilized most of the time. So just to go along this logic, you can see a similar pattern. This is looking at a Germany in the summer. And although I'm looking at the summer, which is very dramatic, of course, the winter and shoulder seasons, maybe not so much solar, for example. But it's a good one to look at because here we understand the boundaries, or you can at least visualize the boundaries of how much flexibility do we need in Germany and in Austria. Austria looks similar, by the way, except that instead of coal, Austria has hydro. Most of it's run of river, so it does have a load following capability. It is flexible, but it's dispatched much like coal, going up and down by 10%. Now in this graph, I think it's important to show, to point out that I'm ordering the generation sources by their rampability. And so coal, the dark gray at the bottom is load following. And then at the top, you have solar and wind in green. And gas is making up the biggest difference that's not accounted for imports and exports, which is the difference between load and production. So I think you need to point out that every system has different generation sources that have different abilities to ramp and efficiencies and pricing associated with that. And the grids have different requirements about how much minimum capacity of each type must be online, ready to ramp, et cetera. So it's not like just because it's going to be a very sunny day, we can shut everything off. Things keep running, and then we export, and we see negative prices and things. This is framing the question. It's a really nice tool called Agorameter. And this is taking that same week in Germany, but projecting it to 2045, and saying, if we have all of the wind and solar, we need to have an energy neutral system. What is it going to look like? The gray areas being what they're calling net load, or this is what we don't know. Is this going to be hydrogen? I can tell you for sure, no matter what a politician tells me about nuclear, that is not giving us the answer, because nuclear would just be a big solid red line at the bottom. But what you can see here is that of all types of flexibility, basically we can ramp about 24 gigawatts for Germany over 2 hours, if you look at the technologies that we now have deployed. And this is showing us that we'll need 50 gigawatt ramp over 1 to 2 hours going forward in the future. And in my mind, BESS is one of the logical, most attainable technologies to deploy at that scale. This is just to show, again, the dispatch sequence is happening here on an hourly basis, but it's really interesting when in Europe, we have this price signal. Here I'm just characterizing it by the day ahead price. I think people will talk later about intraday and other markets and service markets, but this is a good visualization. And basically, when wind and solar are producing most of the electricity that the network needs, the price goes to zero or negative. And it's the remaining amounts that need to be dispatched for those shortfalls that, according to the merit order, are determining the price. Another way to look at this is over an annual basis, price duration curves. But I think what's even more telling is the net load duration curve, which we can see is shifting. Also, the price duration curve for Germany, it's starting to become obvious that we have this flat tail of more and more prices that are zero, more and more of these events, which also suggest the arbitrage opportunity of flexibility in batteries. In my day-to-day work now, I no longer work on the modeling. That's really to the next generation. There's lots of innovative stuff, a lot of innovation going on. So I like to work with fundamental model service providers, and then there's also, the fundamental models are looking at our overall view for electrification, for the pace and direction of the energy transition, what technologies are going to be there, and what price dynamics we're going to see for prices and for the value of flexibility. Coming from those output values, we see these multi-market optimization and trading models. Here's just a number of companies I've spoken with and interact with. But I need both of these to work together to give me a reasonable input that I can talk about in terms of understanding cash flows and revenue. So what I have is my own financial models that are looking at cash flow, and that's a tool that I'm using on my day-to-day basis for negotiating different contracts on the battery side, raising money, allocating risks, etc. Now, before I jump into a bigger picture story about BESS being deployed around the world and how I translate that into the cash flow modeling part, I did a executive course online thing for 3 months last spring. Really enjoyed it. It was called Battery MBA. Anybody interested in that can talk to me afterwards or have a look at it yourself. But that was a platform I used to broaden my knowledge of the value chain in BESS. But one of the highlights, and this is what we're going to talk about, the comparing BESS being deployed around the world, was I was able to put together a team of 8 analysts, co-students, if you will, and we looked at large-scale BESS projects in their countries being deployed at that time. And we thought we could come up with a way to compare them. And this was interesting because up until this year, I think still it's in fact the case this year that China and the US remain the biggest markets in the world for batteries. But with 300 gigawatt hours delivered in 2025, there were big projects done in countries where these were country firsts. So it was really interesting to look at how they were financed, how they were banked. And we did this by using debt structuring to equalize the risks and structure them in a contracted way so that after things like country risk premiums on the debt side, we were able to look at comparing the returns. But it's also, from an abstract point of view, interesting to look at. I thought Ember has a really beautiful set of data now tracking the energy transition by country. And the nature of generation by technology has a lot to say about the needs of flexibility going forward. So Saudi Arabia, for example, 35 million people, 420 terawatt hours of load and growing, is one of the most energy intensive countries in the world, but half of the generation is gas, so they have a lot of flexibility. On the load side, it's related to HVAC, air conditioning, and it goes up and down with weather, as does solar, so it's quite predictable. Brazil has actually a very clean source of power, but its hydro resource is very seasonal and not very flexible. So ultimately, they will also need flexibility. And finally, Malaysia is some kind of hybrid. It will have a lot of solar, but it's really just starting that journey. In addition, countries like Germany and the UK that we looked at are actually seeing electricity demand decline. Although we have expectations for growing electrification, there are countries in Asia that have a higher level of economic electrification within their systems. So we're still waiting for industry and transport to electrify while we continue to use gas. But given that we're at a rate now of over 50%, in fact, Germany is close to 60% of its power coming from wind and solar and biomass and a little bit of hydro, you can clearly see the nature there of the flexible need that I showed earlier in the profile. The other thing to note about Germany and the UK is that it is possible to do projects on a fully merchant basis. The other markets all had single buyer government offtake, which gave them a very predicted offtake that banks, of course, prefer when they're structuring a loan. What we did see are different treatments for degradation, like Saudi Arabia, you're required to overbuild by 25%. Malaysia and Brazil had a degradation, a mandated degradation scale that reduced revenue over time. But without a market signal, we don't know how well these batteries will get utilized ultimately. Whereas in the case of Germany, Austria, we actually have very deep power markets. Like the volume of energy traded on the market, and even though that's double counting for sure, day ahead is roughly a third of the total volume in the entire system. So this is deep, and intraday continuous and intraday are smaller volumes, but they're still respectable for the short time slots that we're talking about. So after structuring the offtake so that everyone had contracted the offtake, and in the case of Germany and the UK, we had to apply tolls. What we have is a kind of plethora of different outcomes in terms of IRRs, and I think the one thing that stood out is that in terms of ticket size, we have much bigger projects happening in other places where there are large contracted projects that we looked at just in our sample. But on the other hand, for the case of Germany or Austria, it's very interesting that the ecosystem of traders and offtake arrangements and some quite innovative players I'll point to later enables the developers to manage risk and come up with a profile that suits everyone. If you're more risk hungry and would like to see higher potential returns, you can finance everything with small amounts of debt or almost all equity. On the other hand, the preference for infrastructure and traditionally for wind and solar is obviously to use as little equity as possible and concentrate equity on new project developments. Yeah. So just a kind of conclusion would be, this would be a setup, say, for a German market, taking a look at a forecast curve and how that fits into cash flow. After debt, you have something called dividend latency for the equity investor here. But what I'm showing in the blue boxes is that you're able to have, say, a toll, either taking up all of the capacity initially or some portion of it for a longer time. This has just emerged as a product in the last 2 years, and it continues to expand in terms of the appetite for different off-takers and in terms of products that can offer it. So to conclude, from my perspective and regards to banks and debt financing, I think there's a lot of innovation around on the energy trading side and service providers on the BESS optimizer side, as well as in terms of flexible power purchase agreements, flexibility purchase agreements, companies like TerraLayer and others that are aggregating batteries and aggregating offtake to enable the developer to have a very flexible but predictable revenue. So with that, I come to the end of my presentation. I thank you very much, and I hope that's going to be a good introduction to the next speakers.
Thank you very much. Sorry. So due to time constraints, we are limited to like 2 questions. You can ask more questions in the roundtable, of course, but for now, let's stick to 2. Max was first.
Thanks, Florian. Thank you for your presentation. It was very interesting. I was just wondering, in light of this highly variable solar generation, if there's been any investment into interconnecting grids like along longitudes, Because, I mean, there's large land masses in the northern hemisphere, and the sun is always shining somewhere.
Yeah, absolutely. There are big projects like Desert Tech and things. I think it's got a new name, but there are investors behind generating a lot of solar power in North Africa and building the grids to bring that to North Europe and the UK. The question is, it's CapEx, and you doubling, tripling the cost of the solar power at that point. It's may or may not be worth it. It's a big question, because we also don't know if the second terawatt hour of solar, right? The first was installed in 2023. The second was installed already by the end of 2024. And basically by now, we're already installing a terawatt of solar every year globally. When Europe slows down, Africa's picking up. I mean, and every doubling of deliveries of solar brings the cost down by another 30% or so. So there's just a lot of moving parts. Yeah.
When you think back, say 5 to 10 years ago, did you expect that rapid increase in solar, and what did you expect? Was it part of your models?
Actually, I was even surprised. I came back to Europe during Corona, and I was really surprised when after the Corona, just coming out of that China again, installed 200 and then 270 gigawatts of solar. That was not expected. That came from partly because there's stimulus, another 4 trillion stimulus came out at that time, and the Chinese economy puts that always back into infrastructure typically because the banks can bank that. But eventually that's going to run out, and in fact China has, and this is really fascinating, they are trying to implement power sector reform. Things that I was working on a few years ago in China now are presumably going to happen, but one has to question whether there is, obviously there's a motivation at the central level, but locally the system is so much based on managing factors of production, including the cost of energy, that it's going to be an interesting journey to see. Also in relation to how the capital market reforms.
Okay, thank you very much again. Let's put your hands together. So basically, he already provided the best bridge when talking about the next generation and building new models. We have now Ekin Khan, a machine learning engineer at Avatar, who's focusing on clustering, forecasting, and data-driven energy solutions. So we will break down more the details of the data pipelines and feature engineering of those models.
Ses 1-2 AB, yes. Thank you for the introduction. Hello everyone. Oh my God, it's a lot of people. All right, so I will talk about forecasting energy volume. We will be in Austria. Thank you a lot, Sebastian, for very high-level introduction. So I have 20 minutes and a lot to cover. Let's get started. So let me give you a brief overview. I will first introduce you Avatar tariffs. So I'm a machine learning engineer at Avatar. We are an electricity provider, and I will give an overview of the tariffs. And after that, we will develop a business case and answer the question of why do we need forecasting in the first place. And after that, we define the forecasting problem clearly, and then we start solution. And we go deep into forecasting task and give how the models actually work in practice. And I do this in 3 layers of complexity. All right. So Avatar is an electricity provider. It has 4 tariffs. It's quite symmetric. We have 2 tariffs for feed-in for PV customers and 2 tariffs for the consumers. And both are hourly and monthly. And the monthly ones are monthly fixed price, and the hourly is a dynamic tariff. So you pay different price for each hour. We can see the very simple overview of energy mix and spot prices. So this is how a typical day look like. This is from yesterday. As you see, the pattern also from the previous slides, the pattern is clear. When we have more sun, prices are negative. So we can actually make money by consuming electricity. And when you go in the peak hours, in the evening hours especially, the prices go higher. And Avatar passes these prices to customers, and customers can shift their consumption to sunny hours to contribute and to be part of the green energy transformation, but at the same time reduce their electricity bill. Yes. So as was described previously, I will also talk about the markets. So as a provider, we have to buy electricity from the wholesale market and sell it to customers in retail. That's the business model, and it also goes other way around for feeding customers. So we first sell in the wholesale market and buy from customers. And this electricity trading happens in 15-minute intervals because we want to keep our plugs 230 volt and with 50 hertz for all times. So we have some monthly tariffs, and we would like to make a month ahead forecast and hedge our position in the month ahead market to not expose ourselves into fluctuating prices, especially in the cases of extreme events such as wars, which are happening more and more often. And the second part is the day-ahead market. Most of our customers have the dynamic electricity tariff, so they pay the day-ahead prices that I showed in the previous slide, and plus the Avatar margin. And today in this talk, I will talk about short-term day-ahead electricity forecasting. And on top of it, we also have the intraday market, which we use to correct our day-ahead position when we get better input signals, such as updated weather forecasts and the actual prices. And finally, we have the imbalance settlement mechanism. This is where our forecasting error is being settled. Let's take a closer look at the imbalance settlement, how this looks. So on average in 2025, average day-ahead price was 95 euros and imbalance price is similar. So on average, they are very similar prices. But the day-ahead prices have like 53 volatility, 53 euros per megawatt hour, whereas imbalance market is 8 times more volatile. And when you see these two figures here, the one on the left, as you see, the price is around 100 euros per megawatt hour, even though it goes plus and minus. And on the right, we see the imbalance price going as low as minus 15,000 euros. And that's a huge number for a company like Avatar. So if we have a 5 megawatt hour forecasting error, we may have to pay 75,000 euros. Like we will have this amount of loss in a single quarter hour. And yes, of course, this also continues for several hours, and this is a massive loss for Avatar. And that's why we don't want to expose ourselves to this price, and we want to forecast accurately. Right. So that's what our result will look like, the product of the forecasting task. So here the white curve is the monitoring curve. This is the truth. And the yellow one is our day-ahead forecast. And the intraday one is a small correction to it with the updated values. All right, yes. So let's define the problem before solving it. Our business requirement is basically 96 real numbers to be given every day. It's actually quite simple when you think from the upper scale. And our data is quantities per customer, so we have the time series of each quantity, and we have some semi-static data, some metadata for customers, which we want to use to forecast them. So there are electric vehicles, there are PV customers, there are heat pump owners, etc. We have this information for majority of the customers at least. And finally, we have also the weather forecast that we want to use for the forecasting task, and we can easily create some time features. We have some challenges about this. First, our quantities is sparse, so we can't create a tensor to process it in usual PyTorch operations, because customers join and churn frequently. And the second one is the 2 days of lag, so we cannot also use some autoregressive models because 2 days mean around 200 time steps behind. And the third one is that we are only interested in forecasting the total quantity. So this is not a challenge per se, but it makes it difficult to model, at least mathematically. All right, so let's solve this problem quite fast and let's develop a very simple solution to this problem. So let's aggregate everything. So we had this data, we had all this data, we can aggregate everything and we can create a single time series of average customer profile. And yes, we have some bunch of features and we train a machine learning model, which is basically a map from 40-dimensional feature space to a quantity. So what the model does is I give model a bunch of data, like I tell it, hey, this is January, this is 12 o'clock, weekend, and time since lower price is 12, which is an interesting feature because we have electric vehicle owners. If they charged their cars yesterday, they're not going to charge it again today, right? We can create such a simple model and we get 14% accuracy from this. And model basically looks in the past and tries to figure out what are the corresponding quantity given these features. Let's take a closer look at how these models work. So this is an XGBoost regressor. This is a simple decision tree-based model. It's incredible that a decision tree-based model can solve such a complex regression problem. But what the model does is model learns to split the feature space. The feature space is the space on the bottom here. This is some sort of configuration space. And on the vertical axis, we have the quantities. So the model learns to divide, create these gray lines, and divide the feature space into boxes. And once training is done, every time I give a bunch of features in this grid, model will tell me X4. This is very simple, robust, and unexpectedly effective model. Yes, so we solved it with 14% accuracy, but we can do better. So we aggregated all customers into one group and we forecasted their average quantity, their average consumption. But what we can do is we can group customers into clusters and do this forecasting task in the cluster level. It's the same setup. We do the same thing, but we do it for individual clusters. Here, for clustering, we use resolution, type, and some device information. If they have EV, heat pump, or if they are business, etc. We don't have this information for all the customers, so we apply a machine learning classifier to cluster these customers without device information. Here, this problem is, classification is very simple. We have a labeled data of 60% of our customers, so we can just use classifier instead of much more complex statistical task of clustering. All right, so this is an overview of clusters. We have in total 14, but we can skip this fast. And when we do this setup, train models for 14 clusters, we get error of 9%. So previously it was 14%, we had 5% drop, which corresponds to 30% drop from our total imbalance cost. but we can do better. So here, in the end, what we are processing is 14 times this data, right? It's just 40, we give model 40 numbers, and it outputs 1 number. That's what the model does. But we want to give model more information. Like we don't want to use only cluster information, cluster average, but we also want to use per station cluster information. And we also want to give model the whole past week of data together with all 10 days of weather features from each station. This is much more data. And still what we want to compute is this weighted sum, is this day ahead electricity forecast, this 96 time steps. And XGBoost model was amazing, but it is not able to learn such a map from, I don't know, like 100,000 dimensional space to one. So we have to process it differently. We have to use deep learning at this point. Yes, this is the architecture I built. I hope this is interesting for you. I wanna quickly walk you through how this works. So the input data is, I divided input data into three segments. First, the past 7 days, and the yellow one, and the red one here. And we encode their information with recurrent networks. Recurrent networks basically, they have one embedding layer, and on top of it, they have the time translation, the square matrix in it. So the model learns how to propagate the time series forward. This is very similar to Hamiltonian of a dynamical system. That's actually pretty cool, at least to me. The next, we encoded the past and the future, and we apply multi-head attention on top to get an output. And finally, we also concatenated with the future features, because even though your past consumption has an impact of how you consume today, what matters most is the value of the features of this quarter hour. That's why we also concatenated with the features, and then apply a bunch of fully connected linear layers. Our model in the end becomes such a map, and we have to define the loss function. The loss we are interested is in it is the cluster loss, it is the total loss. However, I experimented, and I figured that if I add a station level loss, it helps model to regularize and help generalization much more. And this is actually also, I guess, known in the literature. It's a hierarchical forecasting task, and the loss is computed from L2 plus some small eta, which I took 0.01 to compute the loss. Now that we computed the loss, we can run the backpropagation and start the training loop. And as a result of this, we drop our error further to 7%. Right. Thank you for listening. Maybe I list some of small learnings from this project I was working on. Again, I told you the more fun part of the story. I don't know if it was entertaining for you, but it's entertaining for nerds like me at least. But 50% of the job is still data cleaning and standardization of this data. That's inevitable. Domain expertise is a must. You cannot just work with the pure data. You have to understand what data represents. More complex models don't mean better accuracy. If you have higher complexity in your data, then you need more complex models. And in the end-to-end tests are what matters the most. Thank you.
Thank you very much. So again, 2 questions. Maybe somebody else this time. Sorry. Oh, a pleasure.
Hey, thank you for presentation. It's very interesting. Just out of curiosity, because I also work with forecasting, not for the energy sector, but generally with time series analysis. Before you applied neural networks, what was the biggest the best predictors of your forecast? Like what the features were that gave you the best results?
So, like, are you asking what was my best accuracy or best set of features that I implemented? Features. All right. So I listed some of them here. So there is 25 weather variables and the price. And I engineered 14 features, which are like time since lower price, is it weekend, and things like this. An alternative to neural networks is spending a lot of time in feature engineering. And the best I could get with this was 9% with the clusters. And with the neural networks, I could increase the accuracy by 2%.
Thank you for the presentation. I have a question. Who is paying in the end for the error prediction? Is it customers or Avatar?
Yes, that's a good question. Avatar pays for it. So the company pays for it. But what happens is, if we are losing money, then we end up increasing the prices. So in the end, all these imbalanced prices are passed to customers, actually. Yes.
Probably a dissatisfying last question and answer, but
Well,
a bit short. So let's thank again Ekin for his talk.
thank you.
And we'll proceed with the last talk of tonight. We just have to unplug a little bit here. But now I will leave the stage to...
Should I help?
Let me just take this one. To Chris Biankov. So he's
Oh, thank you. Thank you.
the founder and CEO of Podero, which is a Vienna-based clean energy software startup. And he will explain how to enable utilities to aggregate thousands of residual devices, turning everyday households into a massive virtual battery for European flex markets, and thereby enabling consumers to participate in the energy market. So
Thank you very much.
The floor is yours. Maybe it's just...
Thank you. I'll talk to you today about how to use Claude Code for energy. No, it's just a joke. Who here owns a heat pump, an electric vehicle, a battery? Please raise your hands. Amazing. I think there are a lot of people in flats. So on the countryside, we hire. So yeah, I'll talk to you today about how to unlock flex trading for consumers. So already heard from Avatar, of course, how the prices are formed. And now I'll take you one step further and see how I can combine talk 1 and talk 2. So batteries plus the flexible prices and trading and the forecasting to earn money. So who am I? I'm Chris, the founder of Podero. I studied in Vienna at TU Wien and then at CERN. I built a previous company, a data solution as well, for procurement. And now I've been a founder for Podero for the last 3 years. But less about me and more about Podero. So Podero writes software for utilities, like, for example, Avatar. We have countries in many clients in many countries, and we essentially do 2 things. So we save consumers' energy costs, and we earn utilities revenues for utilities. And we do that by enabling them to trade in the energy market. So how does that work? Here you can see Ökostrom, that is one of our customers in Vienna. It's an Austrian utility. They offer power for around 140,000 clients. And this is an ad from when they launched their product. So essentially, it allows consumers to save up to 25% in energy costs. So that's around 100 to 150 euros. And that is done by using electricity not only when it's eco-friendly, so green, but also when it's cheap. And this is essentially what our product does in the background. So it is 6 simple steps in order to arrive at these earnings for consumers. So first, the consumer connects their device, so their heat pump, electric vehicle, their battery, to our software. Then we start monitoring the device, so that means reading our data continuously, processing that data, and of course analyzing it to then come up with possible trades that the utility could do. And we then tell the utility via API to do those trades, or actually there's also another format. You don't have to use AI, you can also use email and Excel, which is still possible in the energy industry. And then the utility ideally earns money. Then, of course, we control the devices to fulfill the trades. So that means following what we have told the utility to buy or sell. And then the utility sends the money to consumers in the end. And I'll walk you through that process quickly, and then I'll explain the software behind it. So we connect to a host of devices, as you can see here, heat pumps, electric vehicles, batteries, EV chargers. And we do this for a number of brands that you can see here. So that usually works via API. So it's a simple setup process where you log in with email and password. Now, I can show you here, this is a white label app that we use for our customers. And essentially here you can see a consumer is logged in, and then you can see all the different energy devices. So that is the solar power, that is the battery connected to solar power, then there's a heat pump, and then there's an electric vehicle. Now these are of course test devices, and I can show you then how to add a real device. So you click on add device, and now we can of course click on the data privacy screen, very important. And here we can, for example, then connect to an Austrian inverter brand called Fronius. And Fronius is a regular inverter manufacturer. It's compatible with most batteries on the market. And if I now connected this, then I could see this device in my app. And so once I've onboarded the device, I can then see details about the device. Now, this is how you connect the device. So now, of course, we can see all the information that device has. And so the consumer has some overview of what's going on. But more than that, of course, is the utility now knows what's going on and can act on this data. So as you heard in the first talk, there's various markets you could trade on. So you have a futures market, that's the long-term buying of energy. So, a utility like Avada, for example, they want to buy energy for those consumers. And so they say, well, I have 100,000 customers, so I'll probably buy this amount of energy long-term for a couple of months. With that, you make sure that you have roughly the amount of energy you need. Now, of course, you don't know what the weather's going to be like, if it's going to be 10 degrees or 5, if the sun is going to shine or not, and of course, what those consumers will do. So as you move closer to the day of use, you can trade on the day-ahead market. That's the second market that utilities usually trade on. And essentially, it allows you to purchase power for the day ahead. So that means now you have a rough idea of what the solar forecast is going to be. You have a rough idea of what the device is going to do. Is it going to be very hot? Is it going to be cold? And so essentially, you then refine your purchasing. So you buy a little bit more energy in times where you need it, or you sell some off. Now, of course, that forecast isn't perfect. So as you come to the day, so to the intraday market, you can actually buy and sell energy again up to 5 minutes before use. And now, of course, I've only talked about purchasing, but what you can really also do is you can do arbitrage. And that means, like we heard in the first talk, you can shift power to different times of the day. So you could say, well, currently prices are high, so I'll reduce my production, I'll sell off that power, and then I'll buy it back cheaper later. And so, of course, the difference is the arbitrage, just like on a stock market. And of course, utilities do this all the time, every day, for their big power plants, for their consumer fleet, but of course not for the devices that we control. And so we essentially enable them to go on that market with the data that we provide. And how does it look like? So here we now see our trading dashboard. Of course, it's in dark mode because you can only do trading in dark mode. And here you can see I'll zoom in a little bit. So here you can see the trading revenues from the first of this year until now. And essentially, you can see the revenue growing, of course, ideally. It is possible, actually, with optimization to only make profitable trades, because you can forgo trades that are not good. You can also see the asset utilization. So that means how much power you're actually buying and selling every day. And we can also now look at a single day. So we can look at, or let's look at this day. So you can look at a single day, and now you see that we're actually starting to trade before the day starts. So we first make a trade on a day-ahead market, or we don't make it ourselves. We tell the utility to do it. And so the utility makes an initial trade to readjust the power from what they've bought over long periods of time. And then as the day progresses, you make more and more trades, thus, of course, filling up the revenue until at some point, of course, the day is over. And what you can see now, we can look into individual trades and then essentially see when we're buying and selling energy. And of course, you have the green bars, which is the buying of energy, and the red one is selling of energy. And essentially, as you can see, we shift power from, it's a little bit hard to see, so I'll go here. I say we shift from green to red. And so essentially, we shift by 50-minute intervals in order to earn money. And of course, every trade makes a little bit of money. And as you would do with ETFs, so financial trades in the stock market, with every single trade, you make a little bit of money, which in end is a big sum at the end. Now, the utility has done that, and ideally it earns money. Once they've earned the money, then of course you need to follow through. So in the stock market, if you buy and sell a stock, there's nothing left to do. You own the stock, that's it. But on the power market, if you don't use the energy that you've sold, or you don't that you bought, and you don't produce the energy that you've sold, then of course you get a fine. I think we heard in the second talk, imbalance cost, if I remember correctly. And so what we have to do is we have to actually steer the devices according to the trades we've done. And here you see one curve where we do not steer the device. So you see in yellow, obviously, the solar power production in gray, the price. And you can see as soon as there is power production, the battery charge here goes up. That means essentially you run as if you were unsteered. Now, of course, that is not optimal because you're feeding in at the lowest possible price. So the battery is fully charged here, and now you're actually feeding into the grid. So this means that you're not solving for the highest price. Now, when we control the device, we can actually correct this to charge to feed into the grid at expensive times and to charge at the cheapest times. And you can actually see not only do we correct for the prices here when we charge during the day, so meaning charging when the price is the cheapest so we can feed in at more expensive times, but we actually also charge the battery fully at night so that we're able to have one additional cycle with the battery, which means, of course, that we earn money for the utility and thus for the consumer. Now, the utility then sends these earnings to the consumer, and the consumer hopefully is very happy about that. But what is now behind that? So this is the data science problem of Podero. You see here we have a bunch of inputs. So this is the historic device data. So that is your load curves, that is your historic PV production, that is your household consumption. And of course, through those, we have forecasts. And those forecasts are calculated every 50 minutes, in some cases every hour in some other cases, to essentially update our estimate of what the base inputs are for our optimization. Then, of course, we also take the live data. So we have to know what's the maximum charge of the battery, what's the minimum charge. Is there, for the car, is the car even at home? Is the device currently running if it's a heat pump or electric vehicle? If it's already charging, of course, you can't. Your base assumption of what to do with the optimizer as you go into the period that you're optimizing for is different. And of course, the prices. So that's the price curve we saw in the beginning, where essentially you have a different price every 15 minutes. And now all these things feed into an optimizer that then calculates a non-optimal solution, but an optimal solution given the amount of time you want to run it and, of course, the number of constraints. This optimizer basically says then this is my optimal battery charge that I would like to steer the device with. And then based on the optimal battery charge, we can then identify what the load curve for each device is. We sum that up, the utility makes a trade, we schedule, and then we steer. And so for the forecasting, I think as all of you know, a lot of the industry uses 7-day forecasts as a baseline. They're actually pretty good. Now, of course, you can get more sophisticated even with averages, but at some point you have to go in the realm of at least some models. There's actually a good model that came out a few days ago, Times FM from Google. It's a model that essentially uses a zero-shot approach, which we're using, and it is pretty good. But of course, you can also buy forecasts. So for some of the forecasts, you will never outcompete the market. So for PV production, for example, it is usually better to buy it unless you have a very specialized company that focuses on that. The challenge with PV forecasts is that tiny variations in location make a huge difference. So if you live in a valley and there's two faces, one facing north, one facing south, then of course, moving by a few hundred meters will have a very different forecast. So there's a limited accuracy you have with models unless you buy them for a lot of money. Now, how does the optimizer work? So for the optimizer, we have to feed the optimizer for constraints. So essentially, this come in our case, in 4 categories. The price data, as I mentioned. So this can be, of course, the day-ahead price. It can be the best bids and asks on the intraday market. So in the intraday market, it's not a price curve that is found, but it's actually individual people trying to buy or sell power at various prices. And if two people find a bid and an ask that match, then essentially a trade happens, otherwise no trade happens. So you're using two price curves actually, in our case, where you're saying, well, what is the best bid and best ask? And based on that, we then optimize the device. Now, you of course also have constraints. If you're running big battery systems like Inspired, you don't have a household connected, you don't have PV connected, you don't have any other constraints. And so you're able to operate very freely. In our case, of course, we have to make sure that the consumer's happiness is first. And so we actually have to consider that the consumer doesn't want you to optimize the battery fully, but only in as far as their household consumption is actually covered. So we're not allowed to just discharge the house. Now, for the forecasts, I mentioned PV and household. Then, of course, you have physical constraints as well, which is where the optimization method that we're using is very handy for. So, of course, you have battery capacity, the maximum charge. You have the constraints of how quickly you can charge and discharge. Of course, you also have to factor in the degradation. So if you were running, it's not possible, but if you're running 100 cycles a day, then, of course, the cumulative degradation would be higher in cost than what you would earn. And then, of course, you have user preferences. So that means some batteries, for example, want to be not discharged under 20%. And the nice thing, of course, is with the optimization method that we're using, which is the mixed integer linear optimizer, we can feed in not just continuous values, but also integer values. So that means, for one, there are certain states that are 0, 1, especially am I charging or discharging? It can't be both at the same time. This is one very handy one. Of course, you also have to consider the time series nature of the problem. So if you're looking at the 5th time interval of the day, you do not want to consider things that are in front of you. The challenge with implementing a good linear optimizer is in finding the right constraints and setting them in a way that they don't have infinite solutions. So essentially, it means that if you were to add more and more constraints, you would add more and more solution possibilities, which then, of course, make it much harder to solve. In our case, of course, as I mentioned, last thing is market rules. So there's also limitations we have from the grid operator, which serve as constraints, which we then use for the optimization. Now, the nice thing about the MILP approach is that we actually have a solution compared to other machine learning approaches where we know exactly why the algorithm decided on a specific reason. So that means we can tune those constraints over time. So that means it's not a black box, but we can actually understand what's happening and then basically tune it based on that. The interesting thing is also that when we simulate the full day. And this gives us the opportunity not just do single trades or trades that are in very short time periods, but actually simulate over longer times. So in our case, we actually optimize for 1.5 days in order to cover the full intraday market from market opening until close. I'll cut it here. We are hiring, so if you want to join us at curiousrepair.com, please reach out. And now opening to questions.
Thank you very much. Let's see. I think there are other questions already. Sorry.
Okay. Oh, thank you. All right. So if I understand correctly, you are aggregating a lot of different customers and you control their devices. So how big is your impact with controlling those devices on the stability of the grid?
It depends, of course, when the device runs without being steered by us, it runs essentially to the utility blind, right? So you don't know when the car is going to come home. You don't know when the heat pump is going to run. And so this causes a lot of imbalance costs. Now, every utility pays imbalance costs all the time. So it's a known factor for the utility. But of course, as you add more heat pumps, more EVs, more batteries, the load curve of the utility becomes more sporadic, thus making every time somebody adds an EV, the grid gets sort of more unstable. Now, of course, with our approach, the utility suddenly knows what's going on and can buy accordingly, which means that the total imbalance cost goes down, which means that the stability of the grid goes down. Now, that at the moment, we're only considering the spot market, so day ahead and intraday, which, of course, is not a TSO or like a grid-based market, which then counteracts stability directly, but our approach counteracts stability indirectly, and thus it makes the loads more predictable, thus meaning that there's less imbalance cost, meaning that there's less stability.
Good evening. I'm Lucas, an energy system architect, and I'm wondering if you're able to control devices automatically. Do I have to set up flexible loads, stable loads, and how does it work in the control system overall?
So there's two sides. There's the consumer and the utility. So as a consumer, all you have to do is you have to connect the device. Let me go into. So once you have connected the device, say for example a car, there are some settings you can take. So for example, you can say, well, I want my car to be charged at 80% every day, or I want a more advanced schedule where the schedule is different per day. But as a consumer, that's it. Now, if you have a heat pump, there's almost no settings. You say, how aggressive do I want to optimize? So you say, what is the optimization grade I want to do? How much do I want to suffer for my savings? It's not that bad, but in theory, that's the picture. And of course, for the batteries at home, you just set the minimum charge that you want at all times. So from a consumer side, it takes maybe 30 seconds, maybe a minute. From the utility side, of course, there's two possible ways to deal with flexible loads. There's the utility proactively telling you, I want you to turn on right now. Or, of course, there's a utility sending you a price script and saying, please give me the optimal solution. At the moment, we only do the second part, which is what is the optimal solution, because it allows us to essentially process all the data at our side and not have a very complicated data exchange. It also means the more important reason is probably that we can calculate things bottom up. So we can find the optimal solution for every device and then sum up, instead of saying, well, you want 4 megawatts now in the next 15 minutes, and we then have to calculate down what that means for every device. But it is possible, and in the future we'll probably also do that.
Sorry, there are a lot of questions, but we will have more time afterwards. We have the round table going on then, where we have more questions, and the people will stick around. Just take your time and afterwards approach them, and you will have enough chance to ask those questions directly. So thanks again for the very interesting talk. And we'll now proceed to the roundtable. So I will ask all the speakers forward once again.
So thanks a lot. Thanks a lot for all the free talks. It was really exciting and interesting to see how we go from grid scale to residential to every single household, especially also to see how we actually get into the machines and now combine. We have heard a lot of topics from like large-scale planning, CapEx, OpEx of these kind of projects. We've learned about time series forecasting to reduce imbalance costs, which in the end benefits actually the consumers. And also another way for consumers to participate and get additional revenue by becoming as predictable as possible by handing over control of their assets to utilities to be able to maximize the benefit of that. One thing I was wondering a lot about is as time progresses, something you mentioned, it's still possible to use email and Excel files. But things are speeding up a lot, right? Things are changing a lot. Also, Sebastian, you mentioned how the European grid market and power market is speeding up in terms of rollout of BESS systems, PV systems, wind systems. How stable can we actually make financial models or time series forecasts when the environment is changing so much, which is regulatory, but also consumers are changing. Taking something like a load profile, as you showed with the Agora website, and now we move 20 years ahead and we assume the same load profile, it's not really going to be accurate. So maybe the first question to you, Sebastian, what could be the ways or how valid are these kind of forecasts in this environment?
Well, I think in absolute terms, none of them are valid. So I look at different ones and kind of think about sensitivities around them. One interesting thing, for example, I've kind of seen is that some forecasters have higher views of the day ahead price. 10 years from now, some of them have it a little bit lower based on their overall scenarios. But then interestingly, things converge when you look at spreads. They correlate more suddenly. So I think it's important to look at the fundamental models, even though we know they're going to be wrong, and the price is not going to be exactly right in the future. But it tells a story that we can understand, and if you take those logical premises into account, you come up with a reasonable view of future. But it's more like not just getting the absolute number right. It's more trying to understand the volatility and sensitivities around certain things. I think also when you work with several forecasters, you start to realize different models have different approaches, different strengths and weaknesses. One thing that I've found they get wrong quite often has been just the fact that the capex cost, say, of solar has been coming down so dramatically, and batteries coming down so dramatically. Capture rates, were falling. People out there, if anyone follows like Leon Hirth, who's been following capture rates for PV since 2015, his model is pretty accurate. Aurora and others were seeing something far more gradual than actually happened. They've clearly had a learning and have adapted as well. But I guess the limits of the knowledge and expertise that each modeler has defines, it's kind of the limits of what they can say.
Maybe just for some people who might not be familiar with the term capture rate, what does capture rate mean?
Well, it's like a volume weighted average by the hourly price, meaning because especially for solar, you produce when all the other solar plants produce, and there's so much solar in the system now that supply and demand. So there's so much supply that the price is declining dramatically. And on average, the ability of a solar plant to capture the market price is weakening substantially over time. For last year, it was 55-56%, say, for Germany, compared to if you would have a nuclear plant or the average price for every hour that would capture the values at all price outcomes.
Mm-hmm. Thanks a lot. And Ekin, on your side, how do you tackle these changing environments in Avatar?
Yes. So first of all, the long-term forecasting is a whole different story, and I believe in more data analysis rather than defining very data-driven models. I think that's the way to go. So you cannot predict wars with models. You have to process data, and humans should involve in this process. But in the short term, I think the story changes. In short term, there are patterns that models can easily capture, and it's very difficult for humans to quickly capture them. And for short-term forecasting, so in practice, in our pipelines, we are currently training models every week and updating them. We also tried with updating them more often, but this is I'm talking about short-term forecasting here. It didn't really help to train them more often. And in the literature, there is this online learning, like every time new data comes, model keeps updating its parameters. There is this notion which I don't have experience with. But yes, I think there are machine learning solutions to this problem in the short-term forecasting.
Mm-hmm. And on your side, do you have the same experience that retraining a lot doesn't help much?
So our forecasting models, I think, are much simpler than yours. So it depends, of course, on the specific model. So yeah, of course, we also don't do anything above 1.5 days. So we're very much in your boat. For the PV forecast, we mostly buy them because there's specialized providers out there. For the households or for specific devices, we do it ourselves. And there, it's usually on a daily basis that we basically retrain or basically update the values.
Mm-hmm. There was another interesting chart you showed when you said that nuclear cannot be the solution because we have this residual load which is always at certain hours of the day, and nuclear just is a flat line and cannot be turned on and off all the time. And we don't know yet what is going to fulfill this gap basically in the next few years. Maybe it's something also that all of you can give their perspective on. Do you see more grid scale flexibility filling the gap? Do you see more residential, or where do you think will the balance be in a few years?
Well, I think it's balanced, and we see that already. There's this kind of combination. If solar plus BESS, those two things together become cost competitive against average prices, baseload prices, particularly in sunny economies. Not necessarily in Austria and Germany because we have strong seasonal influences. But there is really a net load effect because, where we see now, utility scale PV is slowing down because it's less bankable, but the equipment is cheaper, everyone can buy it at the Baumarkt and do a project. So then overall it affects the system because the net load is lower. And so in terms of supply and demand and pricing, it has the same effect, which is not necessarily captured in some models. So yeah, I mean, in terms of then it comes down to how we're internalizing transmission. A big topic for Austria is grid fees for batteries make it unattractive, quite frankly, and this is under discussion currently, but the opposite is happening where there's an exclusion for Germany and other countries where they're now thinking of implementing something. But if the grid costs are such a barrier that it becomes cheaper more locally or underneath one's own home to internalize that generation, there's a larger and faster impact.
Mm-hmm. I would rather skip, actually. I'm happy to learn from you guys.
So it really depends on the country. So very interesting example, we have Belgium and the Netherlands, which are essentially, in most regards, very similar. But Holland and Netherlands has net metering, while Belgium does not. So both have extremely high balance cost, which makes having batteries very attractive. But yet you see in Belgium that 80% of PV installations have battery, in Holland almost none. So I guess what we see there's a bunch of factors. One, of course, is even regulatory possible, which it can not be in some countries. Then, of course, it's a factor of do the installers know it? Usually takes some sort of subsidies to get it kickstarted. So there's an effect where installers won't do it because they simply don't know how to, unless they're onboarded by subsidies or market demand. And then, of course, it depends on the spreads of the country. But overall, the battery costs are declining so rapidly that it seems it probably will be batteries that will deal with the intraday flexibility, both on the BESS side, as of course you know, and also on the consumer side.
So another thing, Ekin, that you concentrated on, basically bringing the cost down, is not just having these buffers, these flexibilities, but getting better models to predict it, right? And you showed us how you brought down the error to then 7%, I think was the last stage. To have a feeling for it, what does this 7% mean for an average avatar customer of InBalance? Like, how much lower would our energy prices go if we would have perfect forecast?
Yeah, so I can give a precise answer to that because recently we were getting 3% margin on top of the day-ahead prices, plus 1.5 cents per kilowatt hour. So now that our forecasts got better and better, and we could save ourselves from the imbalance costs, we could actually drop this price and drop our prices and transfer this to end customers. Whereas for feed-in, we still have problems. We had losses from that, and that's why we cannot drop these prices in the feed-in direction. So it has a direct impact on what we transfer to customers.
Do you think that we're going into a direction that most of the costs we pay are going to be just grid fees and power is going to have like a marginal low cost or no cost?
Yeah, this depends on data. This depends on large-scale data processing systems and large-scale, grid-scale deep learning algorithms that can optimize the grid itself. But I think in this case it is possible. But it's also Europe-wide, right? Many of the imbalance fluctuations in Austria, they come from the international transmission, the unexpected, unintended exchanges. And that's why it's not a problem Austria itself can solve. It's a Europe-wide problem.
I guess we have the belief that currently the margins are very good, right? And you see this with companies in Austria like Inspired, also doing very well. And now I'm leaning into your topic, Sebastian, so you will probably correct me. But we see the continuous drop in solar panel prices and the continuous drop in battery prices to some extent unstoppable. Now, of course, with wind, you would have problems of getting the wind turbine installed, but not so much for solar and battery. And we believe that in 10 years, we'll probably not make any margins for our customers, but we'll sort of be one of the base systems that are necessary to even have a stable grid, because you'll probably have 3x the amount of solar power installed that you can actually use. Of course, the utilization factor will go down even more. But without such a system, you'll simply not be able to offer a stable grid. But I do believe that there's no reason why the prices that we're already seeing in sort of very sunny countries couldn't, at larger deployments of solar, be also possible in Austria. And then, of course, the answer question, yes, it will be mostly grid fees.
Another thing I was wondering is the topic of economy of scale, because you would imagine that if you get a large-scale battery, right, financially it makes much more sense than to have like 10,000 households install like a home battery just to share it. Maybe it's a discussion between both of you. What do you think is, if there's 10,000 households to share it, a village just putting a large-scale battery, would that not make much more sense than everybody installing their own home system?
I mean, there's the efficient market hypothesis that actors are rational. Is obviously not the case. And so the consumers want to have this feeling of autarky to one extent, which of course is expensive. And usually they say, well, 20% of the battery is actually for a power outage. Now, of course, some of them don't know that their battery won't work if there's a power outage because they don't have the right setup, but it doesn't matter. And then I guess from our perspective, the batteries are already there. So that does make sense. If you factor in the grid fees, having a battery at home from a consumer standpoint can make sense, even though if it would not make sense given the higher cost of the battery for a best operator. So it's not clear that there's a right or wrong answer. I guess it only has to make sense for the individuals purchasing it. And since as a consumer, I won't invest in a battery best project and I won't get sort of those returns, saving on grid fees by using my own self-produced solar power and earning a little bit on top with day and intraday trading through Podero sort of is the best possible solution they can find for energy from their perspective.
In a way, batteries, it's just a pure flexible product, and I think it does compete against, it depends for deployment and thinking about as the economy electrifies, as we have more electrified transport and needs to charge in a less predictable way all over the place. I mean, we need more of these shock absorbers everywhere, and it's probably more cost effective to have more batteries strategically located or providing services, but we need markets that define that as something that's competing against grid fees or saving them, I guess, because it's quite frankly more deployable, quicker than building out grid. As we've seen in Europe, there's been huge delays in that in recent years.
I think what we both would like to see is more localized grid markets, as on a DSL scale. This is largely not done, or if it's done, it's still a large city like Stockholm, which is not really the scale that I think both we would like. And it significantly limits how quickly you can, of course, also have solar installation. And I think that's a problem that's not been solved. It's half a regulatory problem. It's half a problem that it's simply hard to find a price point for something that's either fully okay until it hits a threshold where it's, where basically power has to be theoretically shut off. So there's also a challenge in setting up an incentive system that is so binary.
Maybe in a practical question, let's say I have 5,000 or 10,000 euros lying around, and around my home there is like a Bürgerkraftwerk-Initiative where they want to set up a PV, but they also could invest that money to put a roof solar on top of my house. What would make more sense? What I hear now is it makes more sense to have it more decentralized and I cover my own expenses first because no grid fees at this point, or what would you say?
I don't know the prices enough. This is a good question for Claude, probably. No, but It depends on what level you're saving grid fees. So there's some like these energy communities, right? They sort of circumvent part of the grid fees, and then theoretically it could make more sense to have solar installed for a whole, small town in this scenario. But if you always have the full force of the grid fees, this negates a lot of these sort of externally installed solutions for consumers. Now, it's a different story, right? If you say, for example, in Germany, I think if you have a BESS system that you only use for certain types, then you don't pay grid fees. This changes the calculation completely. But I guess that would be not the case in this scenario.
Ekin, also you talked about these different customer profiles that you've set up. And I guess there's also some kind of ranking. Which of these customer profiles fits perfectly to the price curve to have the most beneficial impact on you? What can you say about the different profiles that you identified when you were analyzing?
Well, household customers without any additional device are the best because they are easiest to predict. At least for my job, they are the best. Well, they all have different profiles as you expect. Like if it's a cold day, heat pump customers are consuming really a lot, and no matter what the prices are, they have to warm their houses up. And EV customers usually they search for most of them use some optimizer, and they search for low prices, and they shift their consumption into dead hours, and they actually provide support for green transition. Business customers, I cannot cluster them as business customers because even though they are business, they have very different profiles. So they are scattered around different clusters depending on their consumption pattern.
Interesting. Because we had so many other questions as well after each of your talks, maybe some people made some thoughts about what they would like to ask. I would like to open this up also to the audience to maybe ask their own questions to any of our speakers today. And thanks a lot, Florian, for the microphone.
Thanks also from my side for the deep dive.
Thank you very much. I have a question for Ekin. The last 7%, are they correlating with the high imbalance prices? So basically, is everybody wrong at the same time? Or how does it work?
Yes, so there is a higher correlation. Yes, everybody is wrong at the same time. It's not always the case. There are also situations that we are on the right side of the imbalance price, which means like when all the people forecast negative, we forecast positive, and this has financial gains. But when I average it for the whole 2025, I see that there is quite some correlation, and this is due to some unexpected events happening across the country, I assume, and the systematic errors in weather forecasts, etc.
Okay, for Sebastian, if I may ask, if you could give a very raw prediction of the next 10 years, how would you see the investments for the sector and what would be the demand of the skill force? Basically, realistically, how many people would you actually need for this kind of thing? More or less.
People?
Like, everyone is talking now about the energy sector. China, what you mentioned, is on the news a lot, for renewable especially. And in Europe, they're also broadcasting it everywhere that there's going to be like a revolution in the energy sector. Just curious to see, is it all like, how do you say, will it be like tech where it went crazy, like with AI, or more like small things?
Wait, I mean, I think the way I've seen it progress, it's kind of like it's slow motion. We're always had the feeling that it's energy transition has so many headwinds, it's not happening. You hear the news, Trump doesn't sign the Paris Agreement. And then it turns out actually behind the scenes, the U.S. is installing renewables faster than anyone else percentage-wise because of constructs they had at that time. They're
production tax credit and various things. Texas, having the highest penetration of wind turbines in a, if you would call it a country. I mean, these things would surprise you, that actually in the background, the energy transition is happening quicker than we think. And kind of, to me, things I saw in China are also very true here, is that government and policy, it's always behind, and it's always supporting the state-owned companies who have cheap capital anyways and following their directions. But on the other side, there's lots of innovation happening, and things are coming out that are cheaper and faster, and in the end they get adopted because people can make money on them. And we have the same thing happening here. So whether we'll be exactly carbon neutral by 2035, 45, 50, it's tough, but for the most part, where it's happening because it's the cheapest thing to do. Africa is leapfrogging us now because solar and batteries in a distributed way is the cheapest thing to electrify with all of a sudden, without a subsidy, without the World Bank. And they go from 8 gigawatts to 16 gigawatts, and who knows where it goes from here. Yeah.
Thank you very much. My name is Maxim, and I'm a data scientist in Vinalinian. And my question is, we are getting increasingly bigger fleet of electric buses. And if you would be a data scientist working in the Vinalinian, how would you optimize or benefit of having a fleet of electric buses, but you also want it to be like on the go all the time, so you cannot just like store all the buses in the depots and use it as the batteries? So what would you do, being me?
I guess that one's for me. So I guess the first thing is the way at least we do it is we have to predict if the car is here, right? I mentioned, I showed a case for batteries that are stationary, which is much easier. Of course, in your case, the Vinalina are quite predictable, so that really helps. The core constraint might be if your buses are actually able to be only charged or also can discharge. This changed the equation dramatically. So in the case of most cars that we optimize, they can only charge, they can charge the battery and discharging is driving. The probable hypothesis is that you will most likely only be able to use the nighttime volatility, which is enough to make a lot of money. As you saw in the example I showed, you usually have 1.7 cycles a day, meaning you have almost one during the day, charging at the sort of solar price trough, and then you have one at night when, of course, demand is low. That's sort of the first level. And then it really depends on what kind of markets you have access to, right? If you're doing a simple day-ahead optimization, of course, then it's quite simple. So it is essentially availability, plus, of course, the constraints when buses have to leave, assuming, of course, they can't charge during the day while they're driving all the time. Or maybe there's a factory can delay, but I would assume not. And then, of course, in our case, for example, what we do is we recalculate the trades we can do every 5 minutes. So we essentially look at asks and bids continuously, and every 5 minutes we check what the optimal price curves will be, bids and asks, and then we use the latest forecast. It's usually 15 minutes old or an hour old, and then compute the optimal solution. And we, funnily enough, the schedule, you would assume the schedule is super erratic and that we discharge and discharge all the time, but it's not actually the case because we're changing the schedule a lot, but the final schedule is still somewhat, let's say, continuous in its charging. So we don't charge for 50 minutes and we don't, just because the market doesn't really, the market prices are not really such that you usually have to drop charging. So most of the intraday revenues that we earn are purely virtual. And the schedule is actually not that affected by it because we shift around power quantities as we trade. But in the end, of course, it's we don't charge at maybe 4 in the morning fully. Does it answer the question? Okay.
I see a potential follow-up. Several weeks of engagement coming in.
Hi, I'm Dina, and I used to work with renewable energy from different perspectives. And I have a question for you, Chris. You mentioned that you have different customers. So I wanted to know, like generally, there would be the most added value if you could aggregate as many customers as you could get, or as many market actors in energy market as you can get together. So are you allowed to aggregate all your customer, like the needs of the customer that you service, or do you always need to optimize for this specific utility?
Yeah, it's a good question. So there's in the sort of base case, we optimize per utility. There's markets that utilities usually don't. So say it's the wholesale market. So spot day, hit, and intraday. That's usually per utility, so per balance responsible party. Now some utilities do their trading outside of their own house, so they use a service for it. This is usually only the case for TSO services, unless you're a very small utility. Then you could batch. The nice thing is you'd say, well, if you say you only have 100 batteries because you just started out the collaboration 2 months ago, then you might not get over the thresholds of 100 kilowatt hours per 100 kilowatt per of power. The nice thing is that the utility trades continuously and you can tag along, which solves sort of the cold start problem where you have to have a certain size of fleet in order to start trading. If we had to trade independently, of course, you'd have to have around 500 devices to actually fulfill the minimums. So it's a little bit of a problem if the utility doesn't want to add you to the regular purchasing, and if you have to do it fully separately. It would be much nicer if we could do it fully for all devices, but the utility wants to own the trading just like a bank would want to own their ledger. So it's the core thing they do, right? And so they want to give that away.
Yeah, one more for Chris. Who are your customers actually? Like, I mean, you've been talking about households a lot. Nonetheless, I see the most potential actually the bigger facilities, right? So you have more supply maybe, and also more demand in terms of having a bigger EV fleet, as we've heard from the gentleman before from Wiener Linien. So yeah, just wondering who are your customers and who are your customers gonna be?
Yeah, for sure. So our customers are the utility themselves, and so we have an agreement with them. And then the utility has consumers and commercial customers, so B2B. The reason we do mostly B2C is because those devices are standardized. So everybody has the same 5 Huawei models, or like most Teslas have a way to interface with us. As soon as you get to larger buildings, the system becomes more custom. And this usually means you have to install a gateway, which means you have to go there. And this sort of, for us already then says, well, it's probably not worth it. Now, we would like to partner with the company with the gateway, so if you know somebody, please let us know, that handles the installation and the onboarding. But essentially, it's the way we can scale easiest. There is specialized companies, especially in the cooling space, so for cooling warehouses that just do that. They usually have installation partners to do it, but then they usually focus on a very narrow asset type, which then, of course, makes it hard to find enough customers at that utility. So you have sort of how thinly can you slice multiple target groups until you sort of have almost nobody to market to. And if you just use the regular devices that are present in most households, you have sort of the biggest coverage per utility customer.
Maybe let's have 2 more questions, and maybe let's not strain Chris too much. So maybe there are some questions for Ikin or Sebastian. Thank you.
Hi. This might be a bit of an odd one. I have a strange interest into gravitational batteries, so pulling up heavy stuff and letting it down again. And I think the energy efficiency of it is really bad, but I've not heard of it in like a few years, so maybe any update on this from your point of view?
No, he's talking about the towers.
The cranes.
Or spins, right? You can spin it, you can heat it up.
There's one in Scotland, but it's really old. It's like 50 years old or something. Yeah.
It's not going anywhere?
It's hard to compete with batteries. Yeah. And I guess in our case, the asset's free because the customer has already bought it. And so there's sort of no cost to unlocking the flexibility, right? If you build a big battery system, you actually have to make sure the market pays for it. but in our case, it's already there. So it's sort of it's free storage, and competing with free is quite hard.
You know, as a consumer of chemical batteries, not only is the cost coming down, but the cycles and life warranties are expanding also in a very big way. Yeah, and then you have on the side of that, you know, all kinds of new chemistries and innovation there. So we don't know what's coming out around the corner that has to beat, you know, the kind of incumbent technologies now like lithium iron phosphate. But there's just a lot of innovation, and I think some of these older ideas just don't. Maybe they have a niche somewhere, but just generally doesn't compete.
Okay, let's do one more question then.
Hi, for Aiken. If I understood correctly, you were modeling or trying to understand the consumption pattern of your customers, right? Did you also try to, and you were trying to model that against the day-ahead market, or you're trying also to model the market development between intraday, day-ahead, or trying to understand where the prices are going?
So the question is if I also forecast the price, day-ahead prices.
Intraday. Do you also work on the market side?
Not really, to be honest. It's also a very interesting problem. I'm now getting better at processing more and more data by respecting its symmetries. So my background is more in theoretical physics and mathematics. So I have a geometric understanding of data somehow, and I think price curves are very interesting, and they have very nice symmetries and very complex relationships. I'm looking forward to dive into that, but not at the moment.
I would like to maybe point out one more interesting relationship here. If I take you as a representative for grid-scale batteries and you for avoiding imbalance costs, we haven't talked yet where do imbalance costs go, right? You showed this 15,000 euro per megawatt hour that maybe a quarter hour wrong prediction can do. But you pay it to somebody who is then providing this flexibility. And that basically could go to a grid-scale battery. So the more errors you make in your imbalance or predictions of users, the more money these companies that Sebastian is working with are making. Or the better your predictions are, the less money grid-scale batteries are making. So there's also some kind of competition here, and what's going to come out in the end. But it's also very interesting that all of you are basically also related, because the money is always flowing from one of you to the other of you in one way or the other.
But speaking of where this money goes, I actually have a question about this. So I understanding the balancing mechanism. So part of the money goes there, but in the imbalance price calculation, there is a coupling of three prices: the balancing price, the market forced coupling, and something called scarcity factor. So I get that the first one, the balancing costs go to battery systems usually, but where does the other factors go? Like when the scarcity factor dominates, who gets this money? Do you know this?
We need to invite more people.
Yeah, amazing. There are questions which this round cannot.
Right?
Sorry?
That's true.
Oh yeah, maybe to the audience. If somebody can answer it. But
yeah?
If you like. So I think one part of the puzzle is that if you don't need a lot of ancillary services activation, which is the case when intraday continuous markets create the imbalance prices, then they basically net each other out, right? That means that no large ancillary services activations were necessary, and so you have people who were in deficit, people who were in surplus, and they net each other out, and this is probably where the majority of the brunt of the revenues go. But I don't know exactly by this.
say.
Okay. We figured the second one. We understand the market coupling. There is still the scarcity factor missing, but we figure out.
Somebody else. I could try.
Okay. Let's do this one more. That's good. No, good.
The thing is, the further away the market is from the expectation, the more expensive of a reserve provider the grid operator has to enable. So if it's cheap, they can just call up batteries, for example, and the batteries will fill that gap. But if it's like really far off, they maybe have to fire up an oil plant or something, which is very, very, very expensive, and that's how they couple this price with the scarcity factor, because they cannot really model how they actually grant those contracts to those companies filling those little gaps. So they kind of sort of approximate it, and it's good enough for the most part.
Thanks so much.
It's also a perfect bridge, because we'll now follow up with the open mic, which you started now, which is amazing. But before that, I really appreciate having these speakers here tonight. I think it was amazing. It was a pleasure having you on the stage and having this interactive roundtable. I hope you enjoyed it as well. A big applause for the speakers again.